Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Goslee. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids Resource for a common sense approach to planning, helping to uncomplicate the financial world. We are lucky enough to have Nolan Goslee, one of the partners at Cornerstone Retirement Partners, here with us on the program, and the team from Cornerstone Retirement Partners each and every week provides us some proactive guidance on what we need to be doing or thinking about with our money in order to achieve our important financial goals. And Nolan, always appreciate the time and the guidance perspective that you provide here on the program.
Well, it's always a pleasure to be here, Peter. I like talking about this stuff. I like teaching people about their money and really the role money is supposed to play in your life. And yeah, happy to be here on a holiday weekend too.
Yeah, the celebration of labor, right? All of our hard work celebrated with one day off of work. And
That's
when I
right.
think about that on an occasion like this, as we are doing these kind of programs, Nolan, the real celebration of all of our hard work is retirement. We get one day off per year to celebrate the hard work that we've put in, but really, when we reach the point where we no longer have to trade our time for money and can do more of what we want to do rather than what we have to do to pay the bills, that is the ultimate celebration of all of our hard work.
Well, sure. That's when people experience financial independence. That's when, you have money coming in and, you worked really hard for it. The money that you've worked hard for is generating your retirement lifestyle. And yeah, I mean, that's what we work so hard for. It's nice to have a day off at the beginning of September because it gives you a long weekend, maybe one more weekend to camp or hang out with the family before school starts. But, it really, the end goal, like you said, is that retirement. And how do we prep for it? And how do we prepare for, 10, 20, 30 years worth of retirement instead of just, one day to recognize all the hard work you did?
Well, it takes a lot of work to stop working. That's one thing. And we have to save and invest. It's more than just the work. It's that we have to then put our money to work for us as well. So as we are moving through today's program, we'll talk about some of the things that we can do to improve the job performance of our dollars. During our working career, they're kind of part-time employees. They only kind of have one specific role to grow and to multiply to as many of them as possible. But during retirement, they are full-time employees. They have to provide us with the paycheck and they have to perform all of the roles that we need from our money. So on today's program, we'll talk about how to get our money to behave appropriately, to perform those tasks and to make that transition. Be sure to stay tuned. And as always, if you've got questions or concerns, if you'd like to get a course to retirement, a specific plan put together and mapped out, that's what the team from Cornerstone Retirement Partners will do for you and with you, have a discussion with you about your future goals, and then map out that plan so that you can follow along with the action items, the executable steps in order to achieve and accomplish your financial goals. All it takes for you to get started in that process, pick up the phone, give a call, 616-301-2581, 616-301-2581. You can also always visit online, cornerstone-rp.com, cornerstone-rp.com. If we look back, or if we reflect, Nolan, we actually have it pretty good in America with our work environment today. It hasn't always been easy. Is the modern work environment perfect? No, it's not, but it's certainly better than it has been by far. And it's better than it is in a lot of the rest of the world. And I think that we could all, over a weekend like this, should take a moment to reflect and appreciate that.
Sure. It's real easy kind of to get caught up in all the things that you're supposed to be mad and angry and dissatisfied about, right?
So easy.
I mean,
Yeah.
that's all we're ever shown and taught, and that's all I ever hear, So to take a step back, we're going to talk a lot about labor today. We're going to talk about a lot about working today, but working in America, is really one of the nicest places that you can. I mean, you have the ability to, climb up the corporate ladder if you work at a corporation. You have the ability to start your own business. If you have a good idea, you have the opportunity to invent things or innovate things. And I mean, it's a really wonderful place to work and to live. And it seems like it's only getting better. Again, it's a lot of noise and a lot of what are you supposed to be dissatisfied with, but in reality, a lot of people who work 10, 20, 30 years here in America get a nice, happy, healthy retirement, and they can retire for multiple decades.
Yeah. And it has not always been quite that way. In fact, there were a lot of labor disputes with big employers far back in our history, but there has been continued and constant improvement from help for injured and disabled or workers that contracted illnesses in the workplace to equality between men and women, and then during the Great Depression, creating some unemployment insurance, putting Social Security in place to protect elderly and disabled workers. Just a continued improvement in equal pay and civil rights and age discrimination. Those kind of things have been addressed over our history. And so where we are today, there really is reason to celebrate the ability to go to work, to earn a living, to move up in socioeconomic status, the ability to create our own business, become successful, maybe change ours and our family's standard of living. But at the end of the day, we've got to put in the work, right? There is part of that where, yes, the conditions are there, the opportunity is there, but we have to take advantage of it as well.
Right. And working is what we do, right? And that's what you do the entire time you're prepping for retirement is work, work, work. You lose a job, you got to go to work. You have a bad night, you still got to go to work in the morning. It's eh, there's this work mentality, and we're going to touch on that today, and we'll talk about the role of money and the role of your finances. But one of the biggest hurdles that I ever encounter, and one of the things that I need to coach people through constantly, is what do I do when I stop working? How do I occupy my time? I've worked my entire life, and I've saved my entire life and accumulated my entire life, all of this money and all this savings. Well, how do I spend it? Where do I take it from? What are the biggest risks associated with my money? So yeah, I mean, that's huge for us. You work your entire life. Now, how do you preserve it? How do you treat it the right way? How do you have a happy retirement?
And that's, I think, where the role of a competent, qualified, experienced planner comes in, Nolan, because I and you and everybody listening to this program, we probably know how to work, how to show up, and all that it takes to do the specific job, maybe that we've trained for, that we've become educated to perform, that we've had some experience doing. But not a lot of people, I would say not the majority of the public, understands how to get our money to perform the jobs that it needs to do in order for us not to have to work one day. And once we reach that point, in order to maintain our confidence in our ability to have that level of success.
Yeah, and we've talked about it a lot on our programs in the past, and we'll talk about it a lot today, but it's really just designating what role and what responsibilities is your money going to take in your retirement. Or what does your retirement look like? Where do you have guaranteed money coming from? Social Security and pensions. Where is your income a little more variable? If you have an all stock market based portfolio, income can be variable year to year. So yeah, I mean, just understanding the role it's supposed to play, the risks associated with it, your chances of success or your chances of failure based on where you position your money. So all of those are very important topics to consider.
With all that being said, money isn't even typically the end all be all goal. I mean, we do a lot of things for it. We set our alarms, we show up, we put in sweat and labor, we push ourselves, we get education. We might relocate our families for better opportunities, but the money that we are doing all of those things for really is just the tool to support our values and what's truly important to us. And that's why, Nolan, it's important to save, it's important to invest, it's important to have a plan with our money, and to have a plan to be able to save and invest some of it, not just spend all of it frivolously. And again, that's, I think, the assistance and the help at its core, at its most fundamental, that a financial advisor or planner can help somebody with it, in understanding not only the importance of it, but how to take those steps, that once we've earned it and managed not to save it and lived within our means, what do we do with it next? Because money doesn't do everything for us. We work for it, and we can buy stuff, we can spend it, we can pay taxes, we can save it or invest it. But once we save it or invest it, it's not like it's going to do everything for us automatically. We've got to understand the tools that we have available, and how to use them.
Right. And, understanding those tools and understanding really the role money is supposed to play in retirement is pivotally important to retirement planning. When we're sitting with people for the first or second time, a lot of times what we're doing is talking about the lifestyle that you want in retirement. We don't talk about your money hardly at all, other than basic fact finding the first appointment or two. It's really more about, what are you trying to build for yourself? Like, do you want to vacation a lot? Do you want to work part-time? Do you want to coach little league for, grandkids or something like that? There are a wide variety of things that you can do in retirement, but the money, being able to provide that to you is pretty important. You don't want to commit to, 5 or 10 years of a certain lifestyle, but then have 100% of your money, capable of losing 40, 50, 60% in a year or two. So we'll talk about that a little bit too. How do you protect that lifestyle once you've built it? How do you ensure that your lifestyle is going to be there for 10 or 20 years while you can actually enjoy it? And coaching people through that and helping people through that is really what we do here.
Well, I know you sent along some interesting charts that really challenge a lot of what we are told about our money and what a lot of investors believe. And we'll talk a little bit about that and some of the specific data from the market and from the investment experience a little later in the program. But Nolan, as you're talking about those goals, do you find that people have questions and concerns about their ability to achieve them, as you're talking specifically about what people want to do in retirement, the lifestyle that they envision? On whole, do you think the majority of the American public is very confident they'll be able to live a lifestyle of abundance, or are most of them less than confident, in fact, concerned that they won't be?
I'd say a significant portion are concerned. We ask questions on our social media accounts, or occasionally we'll have, videos or something like that, where we will ask the question, how do you make sure you don't outlive your money? How do you make sure that you have enough for retirement? And a lot of times the responses to those questions are, well, we don't have enough money. Nobody has enough money. Everybody remembers the "What's Your Number" commercial, where you had to have $2 or $3 million floating above your head in order to make that transition.
They never told you how to figure out what your number was, though.
Right,
That's what
exactly.
you guys do a lot.
Yep, exactly. So figuring out that number and what assets you actually need to accumulate in order to generate that lifestyle, and generate that lifestyle consistently. So how to position your money best so that you can make sure that that lifestyle remains intact. I mean, it hurts sometimes when you hear people's concerns and when you hear people's mentality about certain things. Now, I don't think, Social Security is going to disappear or anything like that. But Peter, I certainly think your Social Security and my Social Security is going to be drastically different than somebody who's 65 or 70 right now. So a lot of these programs and a lot of these things are going to need to be reworked. But a lot of current retirees or pre-retirees right now don't have all that much to worry about. If you've accumulated enough to generate a good income and you have a good Social Security, and heck, if you're lucky enough to have a pension, well, it's not really that hard to configure your retirement, but it is easy to lose it if you allocate towards the hot stocks or the hot investments, or anything that you hear that gets that good 1, 2, 300% return. So yeah.
Even bigger than that, though, Nolan, I think several of the charts that you did send along prior to our discussion today kind of call into question whether even the traditional approach to investing in the market produces the results that we expect. because there are periods of time where the market does phenomenally well, but there are also periods that can significantly underperform what we have been led to believe should be our expectations. And because of that, do we assume that we are retiring based off of the good times in the market and the optimal periods, or do we need to formulate a plan based on those times that have underperformed and have done less than advertised and expected? And I think that's one of the big questions that you help individuals work through is, yes, there have been times where the market has done well and you've benefited from it, but how do we want to plan for retirement? What do we want those expectations based off of?
Right. So when talking about at least market-based investing, it's important just to understand some context. So one thing that you brought up here is, some time periods are not as favorable when talking about market-based investing as others. It's really, really easy to have some recency bias over the past, 5, 6, 7 years and say, well, the market's really, really good. And I like stocks and I like the way the US markets are going. And so I would like to invest in US stocks.
It's funny how that recency bias works, only looking at the very recent history and how we forget about the past. Because I remember after 2007 and 2008, how the message in the media was how gun shy the younger generation was with investing, and how they had more of a savers mentality than the baby boomers did before them, and how they almost had a depression era mindset, and that they weren't doing any investing. They didn't want to take any risk or chance with their money at all. And now it's almost turned on its tail and is the opposite. The younger generation seems to be very much into kind of day trading and active management, and they've had a lot of time to research options and cryptocurrency while they've been away from the office during the coronavirus pandemic. So it seems like the recent memory right after the Great Recession caused them not to take any chances or risk with their money. But because we've seen such a phenomenal last really decade in the market, they may be taking more risk than is appropriate.
Right. And I mean, again, it's all about context, and you can pick and slap any decade that you want to onto a piece of paper, and it can either look really, really good or really, really bad. One of the ones that we sent over was just talking about the difference between, the range of the year 2000 to 2013, and then 2000 to present, and even 2013 to present. So let's kind of divide that up a little bit. So there's a tremendous amount of market optimism right now. That usually happens when the economy's been growing, unemployment levels are going down. Obviously, it's going down post-pandemic, but still a lot of good economic growth here. Well, this is kind of similar to economic growth that was happening in the late 1990s. And if we want to take, what's happening now and compare it to back then, I mean, it was very technology driven. A lot of advanced healthcare stuff was going on right now, a lot of IPOs with companies listing on the stock market. And we have a whole lot of that going on right now. Well, if we just place ourselves, 22, 23 years back from where we are right now, the year 2000, the stock market, or the S&P 500, was valued right at about 1,500, a little less than 1,500 points. Well, if we fast forward that to 2013, so 13 years later, the stock market was also at around 1,500 points. So if you just take that decade as a good example of what can happen with two pretty significant corrections or recessionary periods, you have almost a 13-year period where if you were retired and you were drawing money off of your portfolio and you had only invested in the stock market, well, shoot, your stock market investments are right where they were, but you've been taking money out this whole time.
Nolan, you can talk about that decade and you can say, but this decade had two periods where there were significant corrections. But we could also talk about that decade and say within that 10, 13-year period, we had 200% increases in the market value. We had two different periods where the market increased in value by about 100%. And if you just look at that side, you would think, wow, that was a phenomenal decade. But the fact that it lost 50% twice, that 13-year period was essentially flat. If we had invested at the beginning of it, made no dividends and no contributions, also, if we didn't have any fees taken out of our account, we would have had about the same amount 13 years later. That flies in the face of most investors understanding that the market will always go up, or the market goes up over time. That was a long period of time where it didn't.
Yeah, and I mean, especially coming off the past 7 or 8 years, since that 2013 point where we were basically plateaued since 2000, since then the market's been on an absolute tear. From that point in 2013 to the end of 2020, the market went up about 250%, or it went up 2.5 times. It was at around 1,500, and then it was close to 4,000 by the end of 2020. So if you want to look at that time period and you were invested in the market during that time period, well, yeah, you probably made a ton of money. But for that whole 20-year period from 2000 to the end of last year, the S&P only averaged about 4.5%. We like to, we hear a lot, well, the market averages 7%, the market averages 10%, if you're looking at the past 10 years. So on and so forth. Well, shoot, if you look at that 20-year period where you have two big crashes at the beginning and then a really, really significant growth point at the very end, even with that significant growth point, you're still only averaging 4.5%. And if you're paying for, management advice, if you're paying for fund fees, if you're paying for all this other stuff, you probably didn't net 4.5%. So, it's both good and bad to have a market-based portfolio. I like to coach people into having a balanced approach where, yeah, you do take some risk and have money in the markets because you need wind in your sails, but you need a safety net too. You need something that's going to keep your money intact so that if your market-based portfolio goes down 50%, your entire retirement portfolio doesn't do that.
Well, if we look at that period of 13 years where the market had two 50% declines, had two periods where it gained almost 100%, but ended 13 years essentially break even with kind of the roller coaster hills and valleys in between. If we think about that and reflect and say, if we were retired during that time, what would that have felt like? And how would we have coped with a 13-year period where the market did not produce any gains? Or even reflecting on our plan, does our plan depend on those 7 or 8 or 10% returns? And we look back over the last 21 years and say, it's actually only averaged slightly over 4.5. Is that going to be sustainable? Those are the kind of questions we need to examine carefully as we're formulating this plan and understanding what we need our money to do for us, and then assigning those tasks to it and finding the solution that will help us achieve those tasks. That's why the team from Cornerstone Retirement Partners offers the opportunity to help you craft and create your course to retirement. If you've got a plan in place already, they will help you double check it, review it, complete that plan, find any areas that have not been addressed. And if you are not having these conversations, this is one of those areas that does need to be addressed. Those conversations should be had. Maximizing Social Security, minimizing risk, minimizing fees, understanding how to translate and transition the lump sum into the income that we'll need for retirement. That's all part of the planning process. And you can start that process, no cost, no obligation, just have a conversation with the team and understand if you need to have a plan or a plan review. 616-301-2581, the number to call, 616-301-2581, 616-301-2581. Because Nolan, when we think about the things that our money does for us, or that we do with money, we pay taxes, we pay bills, we spend it, and we save it. After we do those first three things, pay taxes, pay bills, and spend, that money is gone forever. Those dollars are gone. It's not going to work for us any longer. Only number 4, what we have saved or invested, will actually work for us to perform jobs, and then at some point in time recreate, hopefully, our ability to do those first 3 things. So we need it to work pretty hard and understand the job that it's doing.
Yeah, and I mean, it's real easy to think about those first 3 and not really think about that last one when you're working. You always think about paying your taxes because, taxes are here and now. Taxes aren't a down the road. Well, they're a down the road thing too.
They're down the road too.
They're certainly a down the road thing too. But if you don't pay them this year, the IRS is going to have you. You pay your bills, otherwise you don't have your stuff, and you spend it on the things that you want, the things that you want to enjoy, family stuff, trips, vacations, whatever, while you're working. But that number 4, that save it, that's that really important thing, because that number 4 is going to generate, that savings is going to generate your entire retirement beyond, whatever, they call Social Security an entitlement now, whatever pensions that you've worked for. Your number 4, your savings, is going to do all of it. You have to use that extra money to recreate your ability to do all of the things you had to do while you were working. So not only do you have to retire, but you still have to pay taxes, you still have to pay bills, and you still have to spend it on stuff that you want to spend it on, to have fun, to travel, to give to charities, whatever you want to do. So in order to make sure that you can enjoy all of this money that you've worked for, you have to make sure that you've saved enough, and that's where we try and help folks. We generate the income plans. We work on your guaranteed sources of income. We try and maximize the amount of money that you're putting into different types of accounts so that you're not taxed on all of your money all at the same time. And coming up with a plan and coming up with kind of like a blueprint for how to prepare for retirement is becoming more and more important, because wouldn't you know it, with a bigger government, we have more regulations. We have more legislations, we have more things that they're trying to do with our savings. And so it's important not only to stay on top of that now, but to stay on top of it for the next 20 or 30 years while you're retired as well. It becomes critically important.
Well, over this Labor Day weekend, as we have maybe an extra day off, hopefully, and we are celebrating all of our hard work, don't we want to think about how maybe one day we don't have to work so hard, and how to have a plan where we can have confidence in our quality of life and our ability to have our money support that quality of life? And if that's what you are looking for with your finances, with your planning, pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581, 616-301-2581. When we come back, we'll talk a little bit more about making money work for you, how to use it to replace the paycheck, how to replace yourself as the chief earner and laborer in your financial plan, and how does a specific written retirement income plan and income allocation work more successfully than the traditional approach of investment with asset allocation for that foundation for our financial stability, security, and confidence moving into and throughout retirement. When we come back here with Nolan Goslee, one of the partners there at Cornerstone Retirement Partners, and if you've got questions or concerns, if you'd like your course to retirement, pick up the phone, give a call. During the break's a great time to place that call, 616-301-2581, 616-301-2581, 616-301-2581. You can also visit online, cornerstone-rp.com, cornerstone-rp.com. We will take a quick break. That's all the time that we have for this segment of the program. We'll be right back with more with Nolan Goslee on Your Course to Retirement.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Goslee. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And we're back here with Nolan Goslee on Your Course to Retirement. Grand Rapids, your resource for that common sense approach to planning. And on this Labor Day weekend, we are celebrating all of our hard work and talking about how one day we can maybe not work so hard, have our money work for us to support more enjoyment in the freedom, the quality of life, doing the things that we want to do rather than what we have to do, and how to be confident that it can continue to do that throughout retirement. That's by having a plan. And if you'd like that plan, if you'd like to get it in place, if you have a current plan but want to be more confident in the fact that it will provide for those future goals, pick up the phone, give a call, have that review, the strategy session with the team from Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. Nolan, before the break, we were talking about some of the things that we do with money. we spend it, we pay taxes, save it, and what we save, it's got to recreate our ability to spend, to pay taxes, to pay our bills into and throughout retirement. Therefore, we really need to make our money work for us. It's got specific jobs it needs to do, and we've got to assign it that task and try to make sure that where we position it will in fact achieve those goals.
Well, for sure. We talk about goals with money. We talk about setting money aside for different purposes. You know, this money's for income, this money's for growth, this money's for kids, grandkids, college funds, whatever. But it's really important just to delineate what money can do. So money can do a few different things here. Number one, it can grow. It can grow either with or without risk. What I mean by that is with risk would be like buying stocks or bonds, things that are a little volatile. Growing without risk might be something that's insured like a bank instrument, almost like a CD or money market. So number one, money can grow. Number two, money can be safe. You can put money in a variety of different insured accounts. You can have FDIC insurance, you can have SIPC protections, you can have all sorts of different things. Number three is to be liquid. So your money can be liquid, meaning you can access it at any time. Your money can also not be liquid. If you have money in property, land up north, things like that, that's not necessarily liquid. You have to go broker it, cash out, net money after taxes, and then you can actually spend it. And the last thing is to provide income. So your money can, generate some sort of, dividends or interest or growth enough so that you can sell things on an ongoing basis to generate some type of income for yourself. But what we need to talk about here is that of these four things, money is really bad at doing all four of them at once. And really, it's kind of bad at doing more than two of these things at once. A lot of times you can have money grow without risk, and that's safe, but it's not necessarily liquid, and it's not necessarily providing you a tremendous amount of income. You can have really liquid investments like stocks, and they grow with risk, but they're not necessarily safe, and they're not necessarily providing income. So, we talk about how money works, but, we need to understand that it can do a couple things, but it can't do a lot of things all at once.
Nolan, I have been hearing more about having a time optimized portfolio, specifically thinking of when you intend to use each dollar and positioning it in accordance with that timeline, meaning that we might be able to take a little bit more risk with money that is intended for further out in the future, but money that we want in the near term for a major purchase, for living expenses, for potential emergencies, sooner rather than later, would be the side that we balance more conservatively. Is there any credence to that?
Yeah. So we help people with that a lot when we're sitting down with them during our first or second meeting. It's really just the idea of separating your money. A lot of people, if you've been working 20, 30 years, you're used to just all of your money being in one account, in one place, invested the exact same way, all with the same risks. Well, what we like to do is kind of divide up. Okay, Mr. or Mrs. Client, here you are about to retire, and you know exactly how much money you're going to need for your first 2 years worth of retirement. Well, it's really easy to set aside that money and say, well, this is my 1 to 2 year money, and I know exactly how much it needs to be, so I'm just going to have it fixed or very low risk and high liquidity. Whereas, you may have some money that you don't plan to access until your late 70s or early 80s, in which case that money you can be a lot riskier with because you have a lot longer to recover any losses that you have in that account. And so it's important to delineate that based on time horizon. And that's what we're talking about here. When do you need to access that money? Is it 1 to 3 years? Is it 3 to 5 years, 5 plus, 10 plus, 20 plus? And all of that money needs to be treated differently as far as how you have it invested and how you associate different risks with that money.
Well, if we are thinking about that in advance, fantastic. But Nolan, when we retire, it all seems like future money until the day that we retire. And then it all seems like right now money. And that's one of the problems with the traditional asset allocation model is it's sort of all geared to be our income generation base, our base for producing income. So if we experience one of those periods where there's a market downturn, if we lose 30% of the portfolio value due to COVID or Corona, or if we lose 40% due to the Great Recession, that's not just our assets at that point in time losing value, that is our income base. And that's why, as we go through that transition to retirement, it takes a rethinking and restructuring of the portfolio in order to make our money work effectively for us.
Right. And I mean, you hit the nail on the head, just bringing up a couple examples of your portfolio going down 30, 40, 50%. We talked about recency bias early in the show and how you can, see stock market returns over the past, 5, 10 years and think, oh yeah, everything's going to be really, really good. Well, if everything's not really, really good and you've invested like you want returns, like we've had over the past few years, if we go through another pandemic, you're probably going to be hurt pretty significantly financially by that. I mean, we would hope that the market would recover as quickly as it did, but it doesn't always. We talk about 2008 and it took what, 4 years, 5 years for the market to come back to where it was after 2007, 2008, and 2009's crash. So, every recession, every correction, everything's a little bit different. If you just have a 100% market-based portfolio in your retirement, I mean, there's a significant amount of chance in there. And you just have to know what risks you're associating with your money and be comfortable calling huge audibles if something like that does happen.
Well, so again, if you would like a plan review to make sure that you are appropriately addressing this risk in your planning, pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. But Nolan, we are replacing that paycheck on the day before we retire. Maybe it's the lump sum that gives us the financial confidence that says, tomorrow I can retire. But on the day after retirement, it is the income that we can produce from that lump sum that gives us continued financial confidence. So we have to then use our money to replace our sweat equity. It must replace our labor. And that's why going through a review of the plan to expose where we need to optimize for our timeline and carefully examining the roles that the money is playing is going to be so important. You have talked about, and Ron has talked about on this program, a concept called income allocation, which is really a pivot and very different from the traditional model of asset allocation.
Well, sure. Income allocation is all about securing income. I mean, you talked about it, replacing that paycheck. So one of the things income allocation does is it allocates your money specifically for income. And this is what retirement planning is all about. Asset allocation is the idea of I have a certain blend of stocks and bonds. This is how my assets are allocated. I'm comfortable with the risk, and this is my expected return. Income allocation is a little bit more involved than that. It's about saying, okay, this is the date that I want to retire. Here's where I have all of my fixed income coming from. Now I'm going to take a portion of my life savings that I've worked so hard for, and I'm going to designate that portion of my money specifically for income. And then once you've designated that specific portion of money for income, you can then go find the best income producing vehicle that's out there. Now, whether that be a blend of bonds, whether it be a fixed indexed annuity, whether it be a cash life insurance policy that has some long-term care benefits wrapped up into it, a wide variety of options are available. But the point here is you're taking a chunk of money and saying, this is going to generate all of my income above and beyond what I'm already getting from Social Security to ensure my income is never going to go away. And then I can do traditional asset allocation with the remaining portion of my assets that I can take a little bit more risk with now that I have my income guaranteed, or as close to guaranteed as I can possibly get.
So does that process actually allow us to be more comfortable with the potential for market ups and downs and taking risk in retirement by defining that income allocation portion of the portfolio?
Well, yeah, absolutely. I mean, it's the same way as running a business. It's the same way as running your household finances. I mean, once you know that your bills are paid on the first day of every single month, you can treat your other money a little bit differently. You can have a little bit more fun with it or a little more enjoyment with your money, and it can start to multitask a little bit better for you. But yeah, ensuring that that money's coming in allows you to take tons more risk almost wherever you want to. It's just the getting there is the most important step. It's making sure that that income is going to be there, verifying through as many statistical measures as you can that you will not outlive your money, and that allows you, yeah, to take a little bit more risk or to have a little more fun. I mean, you mentioned some investments that a ton of retirees ask about, cryptocurrencies and different new investments. People want to invest in wind and solar and battery technology. And a lot of that stuff is very volatile right now because it's a new industry or it's an expanding industry. And so if you want to take advantage of things like that, you have to secure some income so that you can have a little more fun investing too.
Yeah, could be a great opportunity, but when Bitcoin went from 60,000 to 30,000, we don't want our income based on the stability of Bitcoin or really any of those kind of investments that are so volatile in nature. And that's why we delineate and separate and differentiate what we need for income versus what we could potentially take some risk with. And again, that's the process of the course to retirement plan and the income allocation and having the written retirement income plan in writing in your hands. That's what the team from Cornerstone Retirement Partners will do with you and for you. 616-301-2581, the number to call. 616-301-2581. 616-301-2581. Can you go through that process and walk us through that, Nolan, of how we figure out maybe in the red zone before the day that we retire? We don't want to do this the day after we retire, but as we are preparing and thinking about retirement, or even maybe if we are already in retirement, but want to have that plan and feel a little bit more confidence, what is the process that you go through with individuals looking to understand how to assign our dollars these tasks and specifically have that income allocation?
Right. And specifically how to create that income allocation, it's all about, it's literally all about just how do you replace yourself? How do you take all of the money and everything like that you've accumulated and replace your ability to work? The first thing that we do when we're going through this process is defining the budget. We need to actually understand how much you in retirement you spend. And this is after you spend money on taxes, other bills, healthcare. You have to think about what you want your retirement lifestyle to be like. Are you going to be traveling less or more, seeing family less or more? So defining that budget's very important. That gives you your cash out every single month. Now, defining sources of income is the second step there. So how much do I have from my pensions? How much do I have from Social Security? How much do I have from any other guaranteed sources of income or rental income or anything like that? So once you've defined your sources of income and you've defined your budget, you can then identify your income gap. So, how much cash out do I have? How much cash in do I have? And is there a gap there? Now, if there's a gap in those two numbers, well, that's where income allocation comes into play. You can then identify that gap and plan for that gap. You can set aside a stated amount of your retirement savings to say, hey, my retirement income gap is $1,000 per month. Well, I'm going to set aside X dollars right now so that I know by the time I reach 65, that $1,000 per month will be covered, guaranteed, because I planned for it. So once you define that income gap, you can start addressing it. You can address it in a variety of different ways. You can plan for it 10, 15 years from now. You can plan for it tomorrow. But the important thing is to have a plan so that once you have identified that income gap, you figured out how to replace your working income, your paycheck, through these variety of different sources.
And again, that is the income allocation process, the process of defining the role that your dollars need to fill for you and assigning them that tasks for financial confidence throughout retirement, and generating a durable income that you can rely on over the course of your retirement. We've got to go through that planning process and take a look at how investment allocation and asset allocation maybe has failed for retirees depending on the model in the past, and then address those failures. If the market is volatile, if it's up 100%, then down 50%, up 100%, down 50%, and has not gained anything over a extended period, a decade or more, from 2000 to 2013, can we then confidently rely on that model to work out for us over retirement? Or do we need to plan on some of those downturns occurring, and make sure that we are addressing it? That is what the written income allocation plan and your course to retirement really helps you to think about and address in that strategy session and review. Pick up the phone and give a call, 616-301-2581, 616-301-2581, 616-301-2581. Because Nolan, the charts that you sent over, going back almost 100 years, really, to the Great Depression, 1920, 1929, 1932. There have been 14 major bear markets, major downturns, one almost on average every 7.25 years or so. We haven't seen one, not a major one, not a lasting one, for quite some time. But when these downturns occur, it's not like they are insignificant. It's not like if our income is based on the market, we just wait through it. We just ride it out. We just hold on and hope that it comes back.
Right. And holding on and hoping that it comes back is an interesting retirement strategy. I haven't heard the rule of hold and hope. You hear all these other rules, but when you leave that much up to chance, that really is what you're doing. You're hoping that it works out. You're hoping that you don't experience one of these.
I have, however, Nolan, heard investors say, well, I'll just hold on and wait until it comes back, which is fine. That's fair enough when we're earning a paycheck, and we can do that. But when we are retired and need income, that's not something that we can actually do.
Right, because when you're retired and needing income, chances are you're drawing income off of a portion of this money, So if your portfolio goes down by 40% over a 2-year period, but you're taking out 5% per year, which is a common withdrawal rate, your portfolio actually went down 50%. And, depending on what type of recovery and how fast that recovery is on the back end, you may never make that money back. I mean, if it takes 3, 4, 5 years for a 2-year depressionary environment to rebound, which is similar to what happened in 2008. Well, I mean, it's going to take a ton of time for your money to come back. Not every recovery is as quick as what happened during the pandemic. Not every crash is 6 weeks long, and not every recovery is 2.5 or 3 months long. A lot of these do take a lot longer, and that's what we're talking about here with these bear markets. One every 7 years, that's pretty tough, but it's good to be able to rely on something like that, because you can at least plan for it. If you don't want your money or don't want your portfolio to go down by 30, 40, 50%, if the market does, well, it's important to actually understand if your portfolio is capable of that. Are you invested in a way that would go down with the market like that? Are you invested in a way where if we go through a housing crisis, you would also go down 50%? And if so, are you comfortable with that? And a lot of people aren't, especially when you're not working and when you can't just stick it out for a couple more years and not retire because your portfolio went down in value. I mean, when you're retired, you don't have that option.
Well, and you also provided a chart that looks at losses and then how much it takes to gain back in order to recover and break even. And it's really astounding. I mean, the kind of gains that we would need to make if we suffered a 5% loss or a 10% loss, they seem accomplishable. If we lose 10%, we have to gain 11%. Sure, that's happened within a 1-year period of time. But when we lose 20% or 30% or 40%, the kind of gains that are then needed in order to get back to break even seem prohibitive. They seem pretty difficult and unlikely to occur within a short window. Yes, we saw Corona, but that's again an anomaly, how that bounced back. But under normal circumstances, we're not seeing the market produce 40 or 50% returns after losing 20 or 30%, not within a short window.
Right. And that's why when we talk about, investment planning, and when we talk about income allocation, we talk about loss prevention as a pretty critical piece of that. Like you said,
You're not
but
talking about deterring shoplifters
no,
here.
no, not that type of loss prevention. We're talking about, minimizing losses in your portfolio. You mentioned 5 to 10%. Well, that's usually the range where it's, not easy, but not insurmountable to make your money back. Whereas, if you go down 20%, if you have $100,000 and you lose 20%, you have $80,000. Well, that $80,000 needs to make 25% in order to get back to 100. And that's what we talk about when we're talking about these increased losses. If you go down 50%, your portfolio has to make 100% just to come back to where you were prior to losing. Some people are okay with timing the market, taking advantage of dips, buying dips. But again, that is timing the market a little bit. When you time the market, you got to get it right twice. You have to get it right on the way down, and you have to get it right on the way up. A lot of retirees aren't comfortable with that. They don't like the idea of having to come back 40, 50, 100% from these really deep losses. And that's why we try and minimize those losses so your portfolio doesn't have to work quite as hard in order to maintain your retirement lifestyle.
Well, you brought along another chart that shows kind of the typical fees that are being paid, a lot more than most people realize. And that's another factor that's going to impact us, and another reason why we need to carefully examine not only the job that our money is doing for us, but how much are we paying it to do that job, or how much are we paying for the advice and recommendations that we are receiving? Another area that you do need to address in your planning, ladies and gentlemen, and another part of the course to retirement. The plan that the team from Cornerstone Retirement Partners will put together for you helps you understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for into the future, how to plan to control those and minimize those, and how to maximize the available income and the reliability of that income into and throughout retirement. And if you would like to get a look at that, the second half of the game and completing the plan, pick up the phone and give a call, 616-301-2581, 616-301-2581, 616-301-2581. Nolan, as we have this weekend here where we are celebrating our labor, many of us getting an extra day off, ultimately the biggest celebration of our labor is retirement, and hopefully we can enjoy that confidently for 20, 30 or more years. That's the goal. Are there any general rules that you find that most savers and investors and workers want to or need to follow in order to make that happen?
Sure. So we actually have a list of things that really are important once you do decide to retire and when you're managing your finances throughout retirement. Number one, first and foremost, we talked about it a lot today, is to avoid losses using the 5 to 10% rule. Making sure that your losses, at least deep, significant losses, are protected, and you don't lose much more than 5 to 10% of your portfolio at any one given time. If you do, you often have to be way too risky on the other side of that to make your money back, and it just kind of spirals from there. Number two, which we talked about a little bit, is minimizing fees. Fees on an ongoing basis can be a drag on the portfolio. It is important to know how much you're paying for what you're currently doing with your finances and how much it costs to work with somebody. Once you decide to stop working and stop putting money in your 401k, it's very important to know how much an advisor might charge you, or how much you're being charged from a robo-advisor, whoever you decide to use. Number three, significantly reducing volatility. This is a little bit different than avoiding losses, because losses specifically, we're only talking about downturns. Well, reducing volatility on an ongoing basis just makes your portfolio a little bit more predictable. It makes your income more predictable. You're not experiencing these huge 10, 20, 30% swings downward and upward, maybe it's only 5, 10, 15%. And that's a lot easier to manage, both from a financial standpoint and from a mental health standpoint, to just not have to worry about your money being up 10% one day and down 20% the next. Number 4 on this list, we would say earn a reasonable return rate. A lot of times people like to use recency bias, as we've talked about here, and think, oh, the past 5 years, the market's averaged 15, 18%. I don't expect every 5-year period to be like that. And so having reasonable expectations and actually being able to chart those expectations against a comparable comparative. That may seem redundant, but a lot of people talk to me and say, well, the S&P 500 went up 40% last year and I only went up 25. Well, you also don't want to go down 40% when the market goes down 40%. So managing taxation becomes very important too. Generating income from your assets in an appropriate way is very important. But I would say the final and most important piece of this is just having a written retirement income plan. That's probably the most imperative part of all of this process that we've talked about so far. Of all the rules we can talk about, having a written income plan is by far the most important.
That's sort of what brings all of those other points together. It's the written plan for generating that income that you will rely on throughout retirement, replacing your paycheck, replacing yourself and your labor. The biggest celebration of all of your hard work is retirement. We strive to achieve that level of financial success. Unfortunately, without the written retirement income plan, not everybody maintains it. So let's dramatically increase our likelihood of being able to continue that celebration throughout retirement. Pick up the phone, give a call to Cornerstone Retirement Partners, talk with them about the review, about the strategy session, about any specific questions you have, and get that course to retirement, including the written retirement income plan, put together. 616-301-2581, 616-301-2581, 616-301-2581. And Nolan, as always, we appreciate the guidance, the perspective that you share here on the program. And thank you for being the resource for Grand Rapids area savers and investors.
Well, thanks for having me, Peter. Thank you, everybody, for listening. Have a happy and safe long weekend. And we'll talk to you next week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.